Hey everyone, welcome to In the Money with Amber Kanwar. We're just setting up Rick Rule, who's going to be our guest today, and while we wait for him to come, I figured we could kill some time with one of the women behind the scenes here at In the Money Pod. That's Jillian Glickman, our ace producer. I dragged her here, let it be known, kicking and screaming because she did not want to appear on camera.
That's true. That's true. My thing kind of is like I don't go on camera. I'm a producer. I stay behind the camera, but I'm doing it for us, for this. I'm here for you. I'm here for you, Amber.
All right. It's all in service of me. You look great.
Oh, thanks.
You've got a face.
My on-cam debut.
This is how it starts, right? The ego starts to grow. Yeah. So we launched our first episode. And have we recovered from the launch?
I think I didn't sleep last night, but that's okay. I'm feeling good about it. I think one thing that probably our audience doesn't know is that, you know, I think it came out very well, smooth, but behind the scenes, there's always stuff going on.
Immediately, we lost our audio chip, and that was nobody's fault. I'm not pointing fingers, Georgine, but like immediately after the taping with Eric Jackson, we lost our audio chip. What else happened?
Okay, so, well, can we like start before that? Because like, I should just note, Amber just told me to sit closer to the mic because she's like the on-cam personality, not me. So I'm just learning. So I'm going to start like before that. So, you know, we've done a lot of work in the past 2 months, like leading up to this. And one of the big things, obviously, that Amber and I joke about, but it's actually sometimes not that funny, is in our graphics and in all the like writing that we've done for the show. For some reason, the and in the money comes up as capitalized, and we don't want it to be capitalized. So,
like, we don't, but you really can't have it capitalized. Like, it is, the viewers should know, and the listeners, it's the end of the world if the is capitalized, and help you, like heaven help you. If you have capitalized the.
Yes,
I will point the money.
Out.
Oh, she'll point it out. And so there's a big problem with that because our Facebook page, for some reason, Facebook literally won't let me lowercase it. And I've spent like 25 minutes, like, with so much anxiety because I'm like, Jillian is going to be so upset if I can't get this to be a lowercase. So that, as far as I know, is the only place where the is capitalized.
But you know what? I had an idea for our viewers and our audience out there. And I thought, if people see the capitalized anywhere but Facebook, if you see it, if you catch it, let us know. Send us an email. You can send it to questions@inthemoneypod.com. And we will send you some sort of swag.
Well, you got to know what it is.
Well, I think we'll send an In the Money mug, yeah?
It's going to come out of your pocket.
Yeah. Okay, that's
we
fine.
We just started. I only have 5 of these mugs. Okay, so you will get, it's a limited edition, a collector's item, In the Money, lowercase t mug.
Yeah, but that's just like one of many. But anyways, I thought we'd start there.
Yeah, well, maybe that's what viewers can get used to is every episode we'll start with, here's what went wrong today. But hopefully that doesn't happen in this episode. It's time for Rick Rule. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. I want to welcome Rick Rule to In the Money with Amber Kanwar. Rick, of course, is a famed resource investor. Rick, thanks so much for joining us.
Thank you for having me, Amber, and congratulations for going out on your own. I'm delighted to see your career path, and I know that In the Money is going to be a huge success in the market.
Well, thank you. It only works if we help people make money, and so that's really going to be the crux of the conversation that we have today. You've been at this since 1974, and I don't want to date you because you look like a spring chicken, but like that is such a breadth of experience in an area that people really fret about cycles, you know, and this being dead and that being dead, and you've just been in it. The same area, the same sector since 1974. Correct me if that date is wrong, but Like, how does that inform how you invest every day and stay invested every day?
I think a bit about cycles, Amber, in the sense that I'm contrarian. When a sector is out of favor, which is to say, when it has no momentum, when financial markets dislike it, that sector is usually cheap, and I pay attention to it. When it is in favor, in cycle, when momentum is around it, when Bay Street is on it like white on rice, I'm usually a seller. I have found that rather than watching cycles, if I stay with my expertise, if I stay with investments that I know about and know how to analyze, I do well. When I get out of my own circle of competence, irrespective of the cycle, I do poorly. In 50 years, I've learned to confine myself to what I understand and pay no attention whatsoever to those things that don't understand. One thing that 50 years of investing has really taught me, Amber, is not to have any fear of missing out. The idea that you go out of your cycle of competence to be attracted to a sector that has already performed when you don't know about the sector is a wonderful way financially to get spanked. And I don't need any more spankings.
But I feel like it's easy to say, don't get caught up in FOMO, but you also have to change and adapt with the times. And that's such an interesting question in this era because people are wondering about gold's relevance relative to this new shiny thing, digital gold, that is crypto. So how do you kind of navigate that?
I suspect there's a lot of room for both. The Bank for International Settlements suggests that the global value of savings and investment assets worldwide in US dollar terms is something like $830 trillion. The market capitalization of all the cryptos combined is $3 trillion. Both crypto and gold, from the point of view of the global market for savings and investment, are irrelevant. Yes, crypto and gold compete with each other on the speculative fringes. But from my own point of view, they're very, very different asset classes. And when you talk about keeping up with the times, I would suggest to you, Amber, that a very deep knowledge of a sector prepares you to keep up with the times as they impact that sector better than any other technology. Perhaps you, as a journalist, and I'm not disparaging journalists at all, perhaps you, as a journalist, to serve your market, have to try to become an expert in many sectors, or perhaps you need to find people who are experts in many sectors. From an investor's viewpoint, where there's $830 trillion worth of different opportunities, I have no need to be an expert, and I have no ability to be an expert in many sectors. I need to stick very, very, very tightly within my circle of competence.
Now, here's a question because you mentioned, that you get into cycles when they're unloved and you get out when there's too much momentum. How does that apply to gold? And would it be wrong to call you a gold bug, Rick?
It would not be wrong in this set of circumstances to call me a gold bug. I have had periods of time in my career when I owned no gold stocks. I will admit I haven't had a period of time in my career when I could afford to that I've owned no gold. That's a very different circumstance. And I am, as you suggest, guilty as charged.
Let's talk about gold in the current context, Rick, if we can. And actually, this goes to the heart of our first question. Alan in Houston, Texas, wrote us, is gold going up due to inflation concerns? And if so, why are inflation-protected treasuries doing so poorly?
Let's answer the question in reverse order. Treasury tips are doing poorly while gold is doing well because the gold buyer right now is foreign central banks, and foreign central banks are disintermediating out of US treasuries, including tips, into physical gold. The weaponization of the US dollar, the extraterritorial imposition of American power on other countries is one of the reasons why those foreign central banks are selling US treasuries, including tips, and going to gold. The US government has no control over their gold. The former question is different, and that requires a fairly long answer. It isn't merely inflation, but rather the excess of inflation, which I would define inflation as the depreciation of the purchasing power of a given currency, like US dollar denominated currencies, relative to the interest yield that one gets. If you believe the US government statistics, which is to say the so-called CPI inflation number, you aren't concerned. The US government would suggest, Amber, that the purchasing power of the US dollar is declining by about 2.6 to 2.9% annually. I think, and the market thinks, that's farcical. If Americans look to the period 2020 to 2025 at the price of groceries, now a political issue, healthcare, now a political issue, health insurance, rents, home mortgages, groceries, gasoline, the idea that the depreciation of the US dollar's purchasing power is 2.6% compounded is farcical. It's more like 7.5 or 8%. And having a US 10-year treasury pay you 4% in a currency where the depreciation of the US dollar is costing you 7.5% means that if you buy a treasury, rather than making 4%, you lose 3.5%. It's in periods of time historically where savers and investors have been concerned about the maintenance of their purchasing power in fiat denominated instruments like the US 10-year treasury that gold has done well. And here we are.
So let's layer in one of the other anxieties of the market, which is tariffs. The concern that the US is going to bring about either large scale or incremental, depending on the report of the day, but tariffs are coming. What does that do to gold and the environment right now?
Well, first of all, I'll take all comers in terms of bets on tariffs. Americans are pretty dumb, but we're not dumb enough to recognize that tariffs aren't taxes. A tariff is a tax by another name. Mr. Trump, for whatever his skill sets are, is pretty good at voicing the frustrations of his base. He is also pretty good at talking without acting. Anyone who reads his book, The Art of the Deal, will understand that bluff and bluster is the central part of his technique. Now, back to the question after my rant. Gold is fungible. If Mr. Trump puts a tariff on gold from Canada, then the Canadians will sell it in London and Shanghai. Gold is completely fungible. The idea that Mr. Trump will be able to put a tariff on gold exports from Canada, as much as Canadians would like to dislike him, which is easy to do, is a non-issue.
Well, so that's taxing like the physical gold and the export of it, but what does the idea of tariffs do? You know, it could potentially drive up the US dollar. And so there is that relationship that is, and I'd love to get your thought on it, that a strong US dollar means you can't have strong gold prices.
Well, first of all, I think that the prospect of tariffs is fiction. So let's establish that. Having gotten that out of the way, let's talk about your question from a theoretical viewpoint. The US dollar is going to get stronger anyway, because as my friend Doug Casey says, the US dollar is the worst currency in the world, with the sole exception of all of the others. um, I don't think that the US economy could withstand a 25% increase in input costs. If United States automakers were suddenly had a 25% higher cost structure than Canadian automakers or Mexican automakers, the competitive position of US automakers, and I'm just picking on the auto sector, relative to automakers around the rest of the world gets obliterated. We are having enough trouble in the United States maintaining our productive base, given our cost structure and the strength of our currency, without a 25% increase in input costs. Once again, from an economic point of view, tariffs are at best entertainment, but much more correctly regarded as fiction.
Let's distill this down for the viewer. what does that mean for gold prices in the next 12 months?
Nothing. The tariffs mean nothing. The gold prices,
Not just tariffs, but everything that we've talked about. I want to get your outlook.
gold is going to do well because of simple arithmetic. The difference between the yield on US dollar denominated savings products and the underlying rate of inflation in the United States. Tariffs will have no impact on the gold price. The threat of tariffs may have the impact of weakening the dollar as people look at the relative strength of US producers and they think about the impact of a 25% increase on inputs.
That's great perspective on gold pricing in general. Let's go a little bit further into the mailbag because I think a lot of our listeners and audience will want to know, okay, so how do I apply this? Where should I be looking in the market? So we got a question from Arnie in Toronto, actually asking about the Lundin companies, and there are a bunch of them. What Lundin supported companies would you recommend right now? And maybe, Rick, before you give that recommendation, can we just get like a backdrop on like the Lundin family, their experience, why this would be even a neighborhood you'd want to buy a house in?
You mentioned that I've been in the resource business since 1974. I've done business with the Lundin family since 1975. We are now on the third generation of Lundins. The enterprise was started by the late, great Adolf Lundin, and this family has now started and operate companies with a combined market cap in excess of 35 billion US dollars. The idea that culturally the grandchildren of a billionaire remain humble and hardworking is an amazement. But the third generation of Lundin is, I would suggest, as tenacious, as humble, and as brilliant as the first generation of Lundin. I hope that helps in terms of the background. And they run a variety of companies worldwide, as well as being important shareholders of other companies that they have sold assets to. They run Lundin Mining, which is an emerging tier 2 copper producer that I suspect within a decade will be a tier 1 copper producer. They run Lundin Gold, which is one of the most successful single asset producers in the gold business worldwide, and I suspect will also grow by amalgamation. They run a particularly attractive junior, NGEX, which has participated in and in fact originated the Vicuña discovery in Argentina, which I suspect will be one of the 5 most important copper complexes on the planet. And they have long history in oil and gas, including a Canadian heavy oil producer called International Petroleum that I think, well, it has done extraordinarily well. It's a company where rather than issuing shares to the public for money, they are redeeming shares from the public for money. Always a good sign. It's a heavy oil producer in Western Canada, one that will benefit, I think, from your prime minister pursuing other employment opportunities, and also from the potential that our president, Mr. Trump, will begin to lessen the opposition to North America-wide transmission of oil and gas, including potentially the Keystone Pipeline. This augurs very well for Canadian heavy oil producers, including International Petroleum.
So they're really scattered across base metals, as you said, with Lundin Mining, ticker LUN, Lundin Gold, LUG, and then they've got exposure in oil and gas as well. So the question is, do you have a favorite?
I don't have a favorite. That really depends on the investor. Many investors want one-size-fits-all answers. But given that there's 8 billion people on Earth, there isn't a one-size-fits-all answer. I own the waterfront personally. I'm attracted to the Lundins. I'm attracted to their assets. As I say, I've been investing with the Lundins now for 5 decades. I wouldn't describe myself as a loyalist. I would describe myself as an opportunist, and they keep giving me these wonderful opportunities.
Okay, so we're not picking favorites amongst the Lundins. Let's talk about our second question. This one coming from Derek. What are your thoughts on Equinox Gold? This one has been a bit of a sideways trader for a couple of months. Um, what's interesting about this? Do you like Equinox Gold? Would you buy it?
I'm an Equinox holder. In fact, I'm a fairly large Equinox holder. It's run by a personal friend of mine, Ross Beatty, who I've invested with now for 4 decades. Not as long as the Lundins, but a long time. Equinox Gold traded off for 2 reasons. They have attempted, I hope successfully, to put a very large mine in Eastern Canada into production, and they've added a lot of debt doing it. That mine is now producing, although it's not up to nameplate capacity. The financial challenges of putting that mine in production caused them to defer sustaining capital investments at their existing mines in the United States and in Mexico. The consequence of reducing sustaining capital investments has meant that their all-in sustaining costs in those operations have gone up. If they are successful in ramping up the Canadian mine on time, on budget to nameplate capacity and begin to generate a lot of cash from that mine as opposed to sink a lot of cash in that mine and use some of that cash to maintain sustaining capital investments in the United States and Mexico, that stock will do extremely well. I went through the same process with Ross Beatty in Pan American Silver 20 years ago, and it had an extremely successful conclusion. I am counting on I hope wisely, the same outcome for Equinox.
Equinox recently reported its production results for the fourth quarter. I believe it was a record. And I want to speak to that because when you assess these mining companies, obviously the price of gold has to move higher, right? That helps. But how important is operational excellence? Because this is tricky work, right? That they're trying to do. And a lot of people get it wrong. A lot of people have geopolitical issues that they're dealing with. How does Equinox stack up against those measures?
The entire industry rises and falls to some extent with the gold price. In doing stock selection, that goes right to your question, Amber. You focus on management teams that deliver operational excellence. In movie parlance, that's the difference between the good, the bad, and the ugly. Ross Beatty has done a wonderful job over 40 years building companies that have operated more efficiently than their competitors. You mentioned that the company has record gold production, and that gold production should, emphasize, should grow as a consequence of shaking in their Ontario operation. My suspicion is that once the Ontario operation is up and running, that Equinox will sell some of its less efficient operation, which is to say their production might not grow, but their return on capital employed should grow fairly substantially by the disposition of second-tier assets, which will, first of all, heal their balance sheet, and second of all, allow them to focus all of their love and attention on their high-profile assets, and as you suggest, produce the material more efficiently than their competitors.
Okay, Rick, our next question is from Kyle, and he wants to know your take on Osisko metals, I'm assuming, their projects in Gaspé and the Northwest Territories, because of course, Osisko mining was taken over by Goldfields.
Sean Rosen, the power behind Osisko, is another guy who I've done a business with for a very, very long time. I have in almost every circumstance questioned the assets that Sean has acquired, and in almost every circumstance, I've been wrong. Sean has now presided over 3 discoveries and 3 sales, making me, and when I was involved in managing money for other people, a lot of money. I'm not personally attracted to the Gas Bay operation, but in the past, during those periods of time when I've questioned Sean's wisdom, he has been right and I have been wrong, and I look forward to being wrong again.
So this is in Osisko metals.
Yes.
Sean is involved
Yes.
as a shareholder.
Pardon me? Yes, I am a shareholder.
You are.
I am a shareholder. His last success at Windfall Lake was one, ironically, that I agreed with his selection of. But you know what Sean does is he finds promising, reasonably advanced exploration terrains and applies a lot of knowledge and a lot of money and drills them off. in circumstances where other people either didn't have access to the same intellectual capital that Sean does, or didn't have the ability to raise money and develop the assets as fast as Sean has been able to do it. His team's extremely aggressive. They're able to raise money. They're able to employ the money intelligently. And they have a wonderful track record for selecting projects that respond to that application of capital. Whether or not they're able to do it in Gaspé or in central British Columbia or in Tintic in Utah is a different question. But one of the best indications of future success is past success. And this team has been really, truly, stunningly successful in the past.
Okay, so I just want to make sure because there's a bunch of Osiskos flying around. Even though Osisko Mining got taken out, there's Osisko Metals. So you're talking about Osisko Development Corp, which is a smaller cap company that is run by Sean Rusin.
That is correct.
And it's underperformed recently.
I, too, given the plethora of listings that are called Osisko, lose my place in the Osisko play card.
So we just want to be clear for the viewers. We're talking ODV. That is Osisko Developments. We're going to take a break, but before we do, I want to squeeze in this question. This one coming from X, from Newcomer Invest. I'd like to hear what Rick thinks about Nutrien and the potash industry. And I think this is such an interesting time for that question, Rick, because corn is up and it feels like it took a long time for fertilizer shareholders to realize that, right? And there's that close link between if crop prices grow up, farmers are more flush, and then they buy more fertilizer.
I'm a long-term bull on fertilizer. If we see peace in the Ukraine, and if we see the removal of sanctions on Russian potash, what you will see is a temporary near-term weakness in potash worldwide. And that might...
I just want to pause there, like remind people why that is, because so much production comes from there, right? And it was derailed because of the war.
Yeah, the largest and lowest cost producer of potash are the Russians. A second very large producer of potash, although not as efficient, is Belarus. The Canadians are the most stable producers of potash in the world, but not the lowest price producer. I would suggest that Nutrien is the finest integrated fertilizer producer in the world. And as a consequence, they will do well. I think particularly the fact that they've stayed the course in Argentina in very challenging times might position them for a rebound in Argentinian agricultural markets, which could be the beginnings of a game changer for Nutrien.
So let's talk about what that means, because the rally was basically cut in half since 2022. It's down about 50% since then as things kind of normalized and adjusted to some of those dynamics that you mentioned about the war. And it's like perked up a little bit recently. Where do you see it going? How much upside do you think? And is now the time? Do you think we're in, I think an analyst called it, this is a spring thaw, not a head fake. Do you agree with that?
I'm not sure, to be honest with you. I own it because I think it's an extremely well-run integrated fertilizer producer. They have not had problems upstream in production. They've had problems downstream in marketing and distribution. Their challenge will be integrating their global marketing and distribution effort with their very formidable upstream operations. And it should be noted that their upstream operations are not limited to potash. They are good at blended fertilizers. They are really, reasonably good at nitrogenous fertilizers. One needs to look at Nutrien as an integrated agricultural input producer on a global basis that has a durable competitive advantage in Saskatchewan potash.
We're going to take a quick break here. We'll be back with more of your questions from the mailbag. And we are back. We've got Rick Rule joining us of Rule Investment Media. We've been going through our mailbag. We've got a couple more before we get to your best ideas in the space, your pro picks. One of the questions is coming back to mining, back to gold and silver. This one coming from Depeche. Given the level of volatility in gold and silver miners, why would retail investors invest in them versus investing in the GLD or the SLV? These are ETFs that track the price of bullion or silver?
For investors who aren't willing to do the work on security analysis to pick individual issues, they should own the ETFs. I don't own the ETFs because I don't like the idea of somebody charging me a fee to include in the portfolio 20 or 30 companies that I wouldn't otherwise buy with my own money. But that's because I work hard and I'm picky. To the extent that gold equities markets and silver equities markets do well for the next decade, which I believe they will, and to the extent that investors don't feel that they have the education or the willingness to work hard enough to pick individual companies, the equities are a fairly good way of achieving beta in gold and silver markets. And I think the beta in gold and silver markets in the next 10 years will be very good. So I don't discourage the ownership of the ETFs. I just think that they're an inelegant way of portfolio construction for people who care deeply enough about the sector to do the work required to pick stocks.
Let's get one more question in. And this one is kind of more broad sector. I think a lot of people think about you and they think mining, gold, copper, base metals. But you also look at energy, and we're going to talk about that. The spoiler alert, a little tease for the pro picks. But this is a sector question from Learn to Invest Kid. Why does the whole world hate Canadian oil and gas stocks? No respect, not even from Canadian pension plans. Is there a business case for Canadian oil and gas?
The business case is a great wisecrack that stems from your prime minister suggesting that there was no business case for Canadian natural gas, despite the fact that all of your trading partners believed that there was. I think that the reason for the global investor disrespect and the Canadian institutional disrespect for Canadian oil and gas is because your prime minister didn't like the Canadian oil and gas industry and did his very best to thwart the industry that Canada is most competitive at. Those reasons, I suspect, were political, although I'm not Canadian. The truth is that Canada punches well above its weight in the energy business, including in human capital. The export of Canadian technology and expertise to oil and gas businesses around the world is a well-established fact. The durable competitive advantage of producers in the Western Canadian Basin is a well-established fact. The Canadian infrastructure, such as it exists in the West, is a well-established fact. But the other well-established fact is the fact that the political elites in Canada, at least the Laurentian elites, have been foursquare against Canada's most competitive industry for a decade. This is, in Canadian parlance, an own goal. The only thing that has stood between the success of the Canadian oil and gas industry and their contribution to the Canadian economy by way of employment and tax has been the Prime Minister and Parliament.
So, with that in mind, would you take a greater look at this sector based on what looks like the potential for political change in this country?
I would say on a probabilistic basis that that's one of the greatest no-brainers in natural resource investing worldwide. The only impediment to the Canadian oil and gas sector that I can see, or pardon me, the principal impediment to the Canadian oil and gas sector, has just announced his intention to pursue other employment opportunities.
We already talked about tariffs, but I want to bring it up here again because there is concern out there that this is where a lever could potentially show up. And yes, I know the Americans would be shooting themselves in the foot if they decided that they're going to penalize the Canadian energy sector. But is that a risk? You just have to keep it in mind, don't you?
I think it's an opportunity. I think it's a piece of fiction. I think it's a factoid. And I think people are focused on the factoid rather than the arithmetic. I think that one of the reasons for the softness in Canadian oil and gas pricing is a misplaced apprehension that, first of all, the United States can do without Canadian oil and gas exports. That's not true. Or that the Trump administration is not beholden to campaign contributions from hydrocarbon producers in the United States, including Gulf Coast refineries that require heavy sour Alberta crude to replace heavy sour crude that used to be imported to the United States from Mexico and Venezuela. This is a non-starter.
We are going to get some of your best ideas in just a moment, but as I look at them, they kind of are in a different area of the energy sector. So on the pure kind of oil and gas names. Do you have a favorite?
I don't. I think you need to construct a portfolio of Canadian oil and gas producers. It could be that if somebody wanted a one size fits all, that they look to a Suncor or a Canadian Natural, or something like that. I have much more focused names in my picks. I think that the sectors that attract me are natural gas and liquids, and heavy oil, for reasons that are specific to them. I should mention, too, one great risk in the thesis, and that risk is peace. One of the beauties of Canadian oil and gas is it's perceived in global markets as being low risk. And one of the reasons why oil and gas investments on a global basis are becoming more strategic is the potential prospect of a broader war in the Mideast and also the continuation of the war between Russia and the Ukraine. Should peace break out, that's the biggest risk to my thesis. Peace, not tariffs.
Well, that's possibly a big one because we are probably the closest we've ever been to a ceasefire in the Middle East. So does that give you, enough hesitancy before we start name dropping that, that there's a possible pullback on the horizon?
Well, it's worth noting that Canada was competitive in the North American markets and competitive and will be competitive, irrespective of the prime minister, in the exports of liquefied natural gas to Asian markets. Canada has some durable competitive advantages, but there has always been in the back of people's mind the sense that if the Iranians chucked a missile in the Straits of Hormuz, that you'd have $200 crude as opposed to $70 crude. The upside case, the really extraordinary upside case, was always around the fact that Middle East hostilities would worsen as opposed to get easier. Note that at least recently, there has been no hiatus in the shipment of Iranian, Kuwaiti, or Saudi crude through the Straits of Hormuz. So to the extent that peace broke out, you couldn't disrupt something that so far hasn't been disrupted. What changes is the prospect that that vital waterway would be closed in the future.
Okay, we are going to put some of this into practice in the portfolio. It's time for a look at Rick Rule's Pro Picks. This segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Rick, let's get into these picks. The first one is ARC Resources. What's the play?
I would suggest that ARC Resources is all seasons the best managed energy company in Canada. They started in the financial side, went to the oil and gas side, very, very disciplined, very, very competitive, just superior human beings. When they were in the finance side, I used to try to compete with them, unsuccessfully, by the way, which really raised my appreciation with this group of people. As I say, I believe the best run independent oil company in Canada and one of the best run in the world. You start a portfolio with the best of the best. And in the Canadian oil and gas sector, ARC is the best of the best. Maybe not the biggest upside in Canada, but the best juxtaposition of upside with limited downside.
So let's talk about the role it plays in your portfolio. It's already run up so much over the last couple of years. And it sounds like you're saying, don't look at this if you want to potentially double your money, that it's just like a stable part. If you're a believer in the energy trade, this is a safer name.
It's a safer name, but make no mistake, I think the Canadian oil and gas sector is going to re-rate.
What does that mean for ARC Resources? Like if you were to put a multiple on it?
I would have no trouble at all, seeing ARC as a 3-year double. No trouble whatsoever, because I actually believe the Canadian oil and gas sector is going to re-rate. I suggest to you that the hate that was described in your mailbag is going to dissipate and be replaced by love.
Is that the view irrespective of what happens to the underlying price of commodity? I mean, obviously, if it implodes, I know that that's going to dent the thesis. But let's say we hang out in this range where we are right now with oil prices.
That's great. Let's do that. Let's do that. When you look at how the earnings and cash flows of oil producers are valued relative to other sectors in the market, what you see is that the beliefs of the big thinkers of the world, the Angela Merkels of the world, the Trudeaus of the world, the Bidens of the world, that noted energy physicist, what was her name? Greta Thunberg.
Greta Thunberg, yes.
The big thinkers of the world have tried to tell us that peak oil demand occurs in 2030 or 2032, which means that they've assigned no net present value to tail cash flows after 2032. I believe peak oil demand occurs in 2065. And I believe that over the next 5 years, the discount that's applied to the market capitalizations of oil companies, as the market recognizes that demand for hydrocarbons will continue for 35 or 40 years, I believe the whole sector is going to re-rate. I think that Canada will re-rate even more because the principal impediment to the Canadian oil and gas industry is Canada, is the political leadership of Canada. Companies in Canada that have been constrained from shipping oil and gas as a consequence of U.S. politics, as a consequence of the Biden administration's de facto reduction in funding and permitting oil and gas transmission, I think is also over. And so I think that Canadian oil and gas will enjoy better access and egress through the United States. I think that the Canadian oil and gas sector will suffer less headwind from Ottawa. And I think that the entire oil and gas sector on a global basis is going to re-rate as investors come to understand that peak oil demand doesn't occur in 2032, but rather in 2065 or 2070.
Let's get to how this applies to your second pick, tourmaline oil, a little bit more, a little bit different kind of exposure. And I feel like there's an adage around tourmaline, like you don't get fired for recommending tourmaline. Like there's a lot of support around CEO Mike Rose, what he's been able to build. And, of course, it helps investors love those special dividends.
Tourmaline is just an extraordinarily well-run company. There are some groups of people who do things better than other people. If you look at their recycle ratio, which is the amount of new oil and gas that they can discover based on the margin that they've achieved from their existing oil and gas, if you look at their return on capital employed, if you look at the fact that they are able to fund new project investments and fund sustaining capital investments when most of the industry isn't funding sustaining capital investments, and in the third case, simultaneously be generous to shareholders, this is just an extraordinary company. I don't consider it to be a particularly conservative pick. I consider it to be an investment in a collection of assets and a corporate culture that guarantees superior performance relative to most of its peers for at least the next 5 years. Among other things, it's a fun place to work. Great engineers and great geologists like to work for great engineers and great geologists. This is simply a cultural fact.
Do you see more deals on the horizon? Bonavista, Crew Energy, recent big deals. Do they just work on digesting that, or do you think that they can continue to grow by acquisition?
I think that'll be a function of the market's acceptance of Canadian oil and gas. If the Canadian oil and gas sector continues to be cheap, if Tourmaline finds that they can buy potential faster than they can build potential, they will do just that. They are absolutely agnostic as to how they make you money. They just want to make you money. And I want to encourage them to do that in my case.
Let's talk about your third pick, Peyto Exploration. Is it a bit more of natural gas exposure? And it looks like natural gas has woken up from its long sort of hibernation. Are you bullish on the prospects of natural gas, and how does Peyto fit into that?
I mean, the current AECO, Alberta gas price, is plenty for them to make money. But I think it's going to go up. I think in particular, the fact that they don't have the federal headwinds against them, and the fact that with or without Trump or Trudeau, the infrastructure is now in place to begin to move gas out of the Western Sedimentary Basin and liquefy it on the Pacific and send it to Asian markets, means that the gas bubble that's built up in Alberta, the amount of gas that couldn't be sold, is going to decline to the benefit of high-quality natural gas producers. And Peyto is probably the highest quality pure play gas producer in the Canadian seam. I also believe that people don't understand the extent to which Trump may be able to debottleneck U.S. transmission, meaning that even if Canadian gas can't be transported to the Canadian eastern seaboard, liquefied and sold into Rotterdam, that same gas will be able to move into U.S. markets and, in fact, find a home in Europe. There is a business case for Canadian natural gas.
It's got nearly an 8% dividend yield if you buy it here, trading at around 11 times earnings. Is this, a value/income play, or do you see it as a price appreciation play, or both?
Ironically, to the extent that the upside exists in Canadian natural gas sales, some of the money that is now being paid in dividend will likely be invested in productive capacity. So at the same time that their outlook over time increases, it might involve a transfer of benefit from the shareholders in the very near term to continuing to rebuild the business that was destroyed in Ottawa.
All right, Rick, we will leave it there. Thank you so much for joining us with your perspective on everything. I appreciate it. And now, you may not know this, but we do this little thing on the show, and I didn't get your mailing address in time, so it's going to be coming to you in the mail. And I'm glad that you said that you're a gold bug, because our swag bag for you, Rick, is, see if I can open it here. Can you see it? Can you see it?
I can't. I can only see you.
They're cufflinks and they're gold bugs. So
Thank
we're
you.
going to be sending that to you in the mail. That's your swag bag for joining us on In the Money. Thank you so much for being our guest.
Amber, if I might, I'd like to invite your audience to contact me. If you go to ruleinvestmentmedia.com, I personally, for no charge or obligation, will rank listeners' natural resource portfolios 1 to 10. Go to ruleinvestmentmedia.com, list the natural resource stocks that you own. Please no crypto, please no pot stocks, please no tech stocks, just natural resource stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. And Amber, first of all, thank you for having me on. Second of all, congratulations on the career change. This is wonderful.
Thank you, and I appreciate your support, and we'll put that link in our show notes as well. Thanks so much, Rick.
Always a pleasure. Thank you.